Thursday, September 21st, 2017. Monaco 64 here. So the markets, haven't really reacted that much to the Fed's decision. Some people are calling it historic decisions because they're going to unwind their balance sheet, starting to unwind their balance sheet. That's built up from like 800 billion before the crisis of '08 to around 4.5 trillion now. And the way they built that balance sheet was by printing money out of thin air and basically buying US government debt, mortgage-backed securities, in order to keep interest rates low and to keep the banks solvent. Not only US banks, but all the big international investment banks, to keep them solvent. And it's created a massive credit bubble again. The stock market is at record highs. Housing is, booming again, even though here in the UK it looks like it's starting to turn, but still very elevated. And rent, it's really expensive to rent now. Interest rates are at zero. You get no return. So, people have bought property here in the UK, for example, so that they can let the property or rent it to get an income on their money, because if they leave it in the bank, they get zero, sometimes negative. Same thing happening everywhere. And this has been a consequence of their policy. In the stock market, there's been many people, including me, who have been saying, this can't last forever. We might see a crash then. We had the Schmita a few years ago, but the market always seems to come back. So the Fed's created a real spoiled brat of a market, because every time things look like they might get hairy for asset markets, financial markets, the Fed and all other central banks come to the rescue. But they're losing their credibility, and the Fed is like, now they're taking the step, into unwinding their, massive, accommodative, Zimbabwe-like policy of money printing, Weimarish policy, and they're hoping that things go smoothly. As one Fed official said, it's going to be like watching paint dry. I don't know if that's going to be. I think there's going to be a lot of problems, in my opinion, trying to unwind the biggest bubble ever that they've, recorded in human history. The way they're going to start unwinding the balance sheet is that ever since they stopped doing QE a few years ago, whenever bonds matured on their balance sheets, treasuries or mortgage backs, they would take the proceeds and buy new bonds or new treasuries, because the U.S. Treasury, they can't retire debt right now, or they haven't in 50 or 60 years, because they hardly, I don't think they've run a surplus, maybe during the Clinton administration for 1 year. But unless you're running a surplus as the Treasury, new debt is always going to be piling up. So what's going to happen is that the market is going to have to take on, the Fed's place, and that's should normally lead to higher interest rates, because the Fed is like a fairy. They can just create money by typing on the computer. Not like you or me. We have to do something of value to earn money. We have to exchange a service of value, or we have to produce something of value that other people value, that they don't have, that they buy. But the Fed doesn't know about these things. The Fed is just a political monopoly, a parasitical institution that just creates value from nothing. It's almost like God, if you want to say it. I mean, Jim Sinclair says that the Fed is God, and they do act like God. Yeah, one of the reasons why I think the markets have kept elevating, and right now the Dow's at 22,400, is that people the markets. Now, everyone expects that if anything happens badly, the central banks will be there to hold their hands. But if they keep doing that, though, the credibility is going to go out the door. Don't know when that's going to happen, but it will eventually happen. So that's why I still recommend, if you're able to save, your, how can I say, excess production, which is savings or wealth, I would keep most of it in physical gold and silver still. And it is frustrating to see, the price moves in gold and silver, but, you need to be patient. It's like also insurance. As a trader, gold and silver, good luck. You got to do that 24/7. I've done that before years ago. Did quite well, but as you have to look at gold, in my opinion, as monetary insurance. It's also a vote of no confidence on the central banks. Miss Shedlock wrote an article today, I think it was in Zero Hedge, was talking about how when the Fed started hiking interest rates in 2015 in December, that's when gold bottomed, at 1,045. So there's a lot of people coming out now. I don't watch CNBC or Bloomberg anymore, but I'm sure they're saying, yeah, the dollar is going to strengthen. We're starting quantitative tightening. But ever since the Fed started hiking in 2015, at the time, 16th of December 2015, the dollar index was at 98.50. And right now we're at 92.20. So if anything, the dollar's gone down. And historically, and I've made videos before about this, that gold goes up when interest rates go up, especially when interest rates are behind the curve, when the Fed's behind the curve. And I've heard people say that the Fed was hawkish yesterday. I mean, when rates are near zero like they are, 1.25%, I know they seem a lot higher than the Japanese rates, but still historically 1.25% Fed funds is a joke. It's not hawkish. It's totally accommodative. It's all relative terms. So if the Fed was really hawkish, interest rates would be, maybe 5.5%, 6%. That's where they should be. In the UK, they should be 7 or 8. But anyway, looking at the dollar index here, it looks like we're weakening quite quickly here this afternoon. It's about 5 p.m. London, and the pound is up 0.2%. The euro is up 0.5%, and the dollar now is near the lows against the Japanese yen as well. It's pretty much unchanged. So yeah, I think the trend in the dollar is still lower. Of course, we're going to have counter trend rallies. And this is what I think we're seeing right now. Since we made a low on the 8th of September in the dollar at a low of 91.01, and we've been rallying since then. But it looks like that rally is fizzling out. The key resistance is going to be around 96.50, 96.60. I think we got up there yesterday, but now it's turning back down. So watch that line in the sand, 91.01 now. We had an old level, which was 91.91, but that was broken. So I think now the new level to look for is 91 in the dollar index. As for gold, today we reached a low of 12.88. We're now 12.94. Silver is rebounding quite well. We dropped to 16.82 and are now back above 17. I think we're near a bottom in gold time-wise. I don't know about the price, but usually after the Fed makes a big move like they did yesterday, I know they didn't move on interest rates, but they moved on the QT and formally announced it. We see a bit of weakness going into those kind of meetings, and then for precious metals, and then after a few days, 1 or 2 days, the precious metals start going up again. We'll have to see. So yeah, If you enjoyed this video, please like, share, subscribe to my channel if you haven't yet. And you can also follow me on steemit.com and also on Twitter. And I'll talk to you later. Bye.